$175 billion in deposits, gone in 48 hours. Not hacked, not stolen, not embezzled, just legally, voluntarily withdrawn by people who were supposed to be the smart money. It started with a simple, boring, completely legal bet. SVB, Silicon Valley Bank, was the bank for startups, the place where every hot VC-backed company parked its cash. So when pandemic-era money flooded tech in 2020 and 2021, SVB's deposits exploded from $60 billion to $190 billion almost overnight. So the bank did what banks do. They invested that cash, except they put most of it into long-term government bonds, the kind that only pay well if interest rates stay low forever. Translation: they bet the whole vault on cheap money lasting forever. Rates won't move. CFO agreed. Park it in treasuries. But here's the part nobody tells you. Those bonds were safe on paper, but underwater in reality. Because when the Fed started hiking rates in 2022, the value of those old bonds collapsed. SVB was sitting on $15 billion in unrealized losses, and barely anyone outside the building knew. What could go wrong? Everything. Enter Greg Becker, SVB's CEO, confident, connected, the guy who literally lobbied Congress to loosen banking rules for mid-sized banks in 2018. By early March 2023, the bank was quietly scrambling. They needed to raise $2.25 billion in fresh capital to plug the hole, and on March 8th, they announced it publicly, which was supposed to calm the market. Instead, it was like yelling fire in a crowded theater. Meanwhile, in the group chats and signal threads of Sand Hill Road, the most powerful VCs in the world, Peter Thiel's Founders Fund among them, were already telling their portfolio companies to pull their cash. Not in a week, now. The digital bank run began at the speed of a Slack notification. On March 9th alone, customers tried to withdraw $42 billion, roughly a quarter of all deposits, in a single day. One single Thursday, SVB's stock dropped 60% before noon. March 10th, SVB doesn't fall, it implodes. By 8 a.m., California regulators had already made their decision. The FDIC swooped in before lunch. The bank was closed, not restructured, not saved, not given a weekend to figure it out, just shut. The $250,000 FDIC insurance limit suddenly mattered a lot because 93% of SVB's deposits were above that limit. Thousands of startups woke up that Friday morning technically unable to make payroll. Employees refreshed their bank apps, founders called lawyers, the Slack messages stopped being professional. Sarah, the office manager at a Series A biotech startup, checked the company account that morning, the one they used to pay 43 salaries. The balance showed zero accessible funds. Not metaphorically frozen, actually frozen. Not because of bad loans, not because of fraud, because a tweet traveled faster than a wire transfer. The weekend scramble was extraordinary. The Fed, the Treasury, and the FDIC jointly announced on Sunday night that all depositors would be made whole, not just the insured ones, because letting thousands of startups fail would have triggered a second wave of economic carnage. The architects of the problem, the executives who built a $212 billion bank on an interest rate bet and lobbied away the oversight that might have caught it, they walked with their bonuses already paid out in the weeks before the collapse. The depositors got their money back. Eventually, the shareholders got wiped out completely, and Greg Becker got a congressional subpoena and a multi-million-dollar exit package. And here's the part that should keep you up. You probably cheered for SVB's model at some point because it was funding the companies that made your apps, your tools, your world. Actually, the collapse wasn't a system failure. It was the system working exactly as designed, right until it wasn't. The rule changes SVB lobbied for in 2018, the ones that exempted mid-sized banks from stricter stress tests, were finally reversed in 2023, after the collapse. After. The Slack message that started the bank run, it's still out there. And the next bank run won't need 48 hours, it'll need 48 minutes. The exits are getting faster.